If you trade smart money concepts or basic order blocks, you've likely lived this exact scenario. You find a clean down-close candle, you draw your box, set your limit order, and wait. Then the market opens. Price completely ignores your level, snaps shut on your stop loss, and instantly rockets in your original direction. In the next 6 minutes, we are going to look at why that happens. You're going to learn how to move past trading blind historical boxes and start following a mathematically backed algorithmic workflow. To follow along, you only need 2 things: an active TradingView account and our custom liquidity matrix script loaded directly onto your chart. By adopting a mechanical execution process, we can replace subjective interpretation with objective data, providing a framework to help manage the pressure of the trading process. Looking at this interface mockup, the left side shows how retail traders operate. They clutter screens by treating every down-close candle as a valid setup. The right side is what we want to achieve. The problem with drawing static boxes everywhere is that a 1-minute candle from a sleepy lunchtime drift looks exactly the same as one driven by aggressive institutional buying. It ignores actual market momentum and volatility. Our algorithm requires 3 data streams to converge: MACD wave momentum, average true range expansion, and volume asymmetry. This is our core rule: no wave, no trade. Without all 3, it's just retail noise and fades out of view. You don't have to calculate these metrics yourself. The script runs the math in the background, keeping your interface clean and only painting true institutional ignition levels. Systematically filtering out unstructured data is a prerequisite for aligning your execution with how institutional algorithms actually operate. Now that your chart is cleared of the noise, step 1 is to scan the price action for Class 1 and Class 2 wave block indicators. This is our first target, the true C signal. You'll recognize it by this lime green triangle icon and the thin dashed orange midline. This Class 1 signal marks the primary ignition. It identifies the moments where institutions sweep liquidity and initiate momentum into the market. Next, we look for our secondary and more critical target, the nested true C signal. Notice in this mockup the cyan badge icon and the thick dotted orange midline, which is noticeably heavier than the primary signal. When this nested signal appears, it indicates that institutions are aggressively stacking new size on top of their original positions within our specific lookback window. By isolating your setups and waiting for this specific nested signal, you ensure that you are riding confirmed, compounding institutional momentum rather than getting trapped in an isolated price spike. With the signal identified, we move to step 2, risk management. The system automates position sizing by calculating risk based on your specific account parameters. Here, in this dark mode telemetry panel, the live HUD, you will input your exact account size, in this case $50,000, and set your specific risk tolerance, which we have set to $500. The script measures the volatility distance of the active signal block and instantly outputs the precise contract size required. Right here under critical payload, it tells us to trade exactly 2 contracts. Step 3 is execution. You'll locate the automatically plotted entry coordinate, which the script locks directly onto your right-hand price scale. This diagram shows the mechanics of the entry. You let the price pull back to the 50% nib line, looking for a rejection at that exact tick to confirm the order flow. It's important not to chase the price the second the cyan badge appears. Success with this system depends on having the discipline to let the market come to you and wait for that pullback. By automating the position sizing math and locking in the exact entry coordinate, you address the 2 areas where human error most frequently impacts a trading plan. You now possess a mechanical framework. You can execute trades using a process where every step is mathematically validated, rather than guessed. Let's review the milestones. We eliminated the static chart noise, we identified a confirmed nested wave, we automated the precise risk sizing, and we identified the exact equilibrium zone for execution. To put this system to work, check out the link in the description below to acquire the Liquidity Matrix script. Load it into your trading platform and begin executing your setups. Moving from retail guesswork to this level of precision is the transition from subjective trading to true quantitative trading.